Today I'm going to talk about futures and forwards. Maybe just to start off with a brief introduction of what is a future and what is a forward. Let me talk about what is a forward first. Assume that we have two parties, A and B. A wants to buy a share which is currently trading at say $400, but he doesn't want to buy it now. He wants to buy it say 3 months into the future at say $450. He thinks that 3 months later the price will be more than $450. Okay, so B is willing to take a bet with A, and B says, okay, I'll be willing to sell it to you at $450 3 months in the future, because B doesn't think that you go up that much. So A and B enters into a forward transaction, okay, which matures in 3 months, and the forward rate, as we mentioned just now, is 450, and the current spot price now is 400. So this is essentially what is a forward, and it has a few characteristics whereby the whole transaction will take place in the future. Nothing is going to be exchanged now, and I'll show you the formula between the forward and the spot price later. And okay, let's move on to what is a future. Basically, it's really very much the same as the forward, except that in between A and B there is an exchange. Okay, basically an exchange is just an organization which takes care of the buying and selling, and face off to the different counterparties. So instead of A buying from B, A will buy from the exchange, and the exchange will sell to B. So exchange becomes the middleman between A and B. Exchange is simply a medium whereby the transactions take place, and it's good for managing credit risk, because exchange manage credit risk by the use of this thing called margin. Okay, so A and B will place a certain amount with the exchange before they can trade, and every day when there are movements in the prices, A will have to either top up when there's a loss, or you'll see again when there's a profit. And similarly for B. So exchange basically manage credit risk on behalf of A and B. Okay, imagine when there's no exchange, if A makes money and somehow B becomes bankrupt, A has no recourse, and A will stand to lose the whole amount that it gained. So with the exchange, it manages the counterparty credit risk via this mechanism called the margining. Alright, next I'll go into the formula that links the forward and the spot. Basically, let me write down the formula first before I explain further into what the formula is about. Basically, the relationship between forward and spot is given by as follows. Okay, this is for compounding one period, and if you want to write in the continuous compounding form, it will be like that. Okay, so they are very much the same, because when the interest rate is low, these two will work out to be very much the same. Okay, so let me show you why this is the case and why this formula is as such. Let's imagine that we have two portfolios, portfolio A and portfolio B. Under portfolio A, simply invest in the stock now. So as at T equals 0, you buy the stock at today's price, S equals 0. In portfolio B, instead of doing this, we invest in the forward. Okay, forward at at a price of F0, and you deposit the cash into a bank which earns you a risk-free rate, okay, of R, risk-free rate of RF. And how much do you deposit? You can deposit F0 over 1 plus risk-free. Okay, so you deposit this amount into a bank and earns you the risk-free rate. Okay, so this is basically the structure that I want to start with, whereby you have two portfolios and you do certain thing in portfolio A and do certain thing in portfolio B. Let us look at what happens when you reach T at the maturity of this forward. Okay, so at T, right, the stock price will become, say, ST. So what happened in this scenario? This is a forward that you entered with a counterparty, and this forward you exercise the forward such that it becomes ST. And when you exercise this forward, you have to pay your counterparty cash equivalent to F0, and this is obtained from the deposit that you place upfront as a T0. Okay, so basically at the end of T for portfolio B, you will be getting the stock ST, and there's no further cash outlay for portfolio B. So we can see that as at T, both the portfolios are giving you the same amount as T, which is the stock price as at time T. And by the same argument, we can show that it has to be the case such that the value as at T equals 0 has to be the same. Okay, so you can see that value as at T is 0. This one has no cost because it's just a contract that you agree up front with the counterparty as at time 0, and the whole settlement will take place at time T. So as at time 0 for portfolio B, the only outlay or cost will be this value. Okay, so this has to be equal to this as at time 0, and this is how we equate and obtain the formula for forward. Okay, basically just rearrange the whole formula and you can obtain this formula. Yeah, so this is quite straightforward. And okay, so let me move on to the future, and I'll show to you why formula for the future is slightly different from this one, and it won't be exactly equal to this one because of the concept of margining. I won't be showing you the exact formula, but I just want to go through an intuition of why this is so. Assume that we have a 3-month forward agreed at $500. Let's say we want to buy a share agreed 3 months away from today, and we agree that we will buy from counterparty at $500. Let's look at the first month. Assume that the spot is 520. For forward position, there's nothing that needs to be done because it's a forward. You just need to do nothing and wait until the 3rd month. But for the future, assume that the spot is 520. We'll be making a gain of $20 from the counterparty because 520 less $500 that we agreed upon. So there'll be a future a profit as at month 1 of $20. Assume the interest rate then is 0.5%, and we'll be earning interest in the margin account of 0.01, and so on and so forth. And as a month 2, spot becomes 540, forward again 0, future P&L 540 less 520 is 20, and let's say assuming interest rate is 0.6, we'll be earning 0.1 as well. And as at the 3rd month, where the maturity month, let's say the spot is now 490, we'll be making a loss of $10 in the forward. It's time to settle the forward, and unfortunately it's a loss for us. So it's a $10 loss. For the future, we can see that the price moved from 540 to 490, and it's a loss of $50 for that month. assuming the interest is 0.3, we'll be paying 0.01 interest. So all in all, for the forward, we lose $10, and for the future, if you add up the full monthly profits or loss, we also lose $10. But it's not all for the future. Look at the interest part. We have made 0.01 in the interest for our future, because primarily because of the gains in the first 2 months. Okay, so for the total, all in all, for the futures P&L, we don't lose the full $10. We only lose $9.99. Okay, so you can see that there's a bit of added complexity in the valuation of futures, and it is quite complex because we have to model the stochastic movements of the interest rates and also the spot. Whereas in the forward, nothing needs to be done. You just wait until the end of the whole maturity to calculate the P&L. But for the future, it's necessary to calculate to sort of forecast the movement of the spot and the interest rates in order to obtain the valuation of a future. But given a low interest rate currently, all this is almost zero. As you can see, in the work example, there's only a very slight difference between the forward and future. So I think most participants really ignore this aspect of the future valuation and just assume that the formula that I've shown you applies for futures as well. Okay, that's about it for today. Next, I'll talk about the valuation of forward rate agreement, which is actually a form of forward, but we are going into the interest rate space. Okay, till then, thank you, bye.